Stocks gave Ben Bernanke's stagflation press conference a big Bronx cheer today. Ending a 4-day win streak, the Dow headed south for an 80-point decline shortly after Bernanke began delivering his dour economic assessment. So, how does an investor play this? Was the recent rally just a head fake, or does the market really have some more upside? Let's talk with Russ Koesterich, iShares Chief Investment Strategist at BlackRock, and Lee Munson, Chief Investment Officer at Portfoliio. Russ, welcome back. Where are stocks going? We got Bernanke, we got Greece. We have a more optimistic Fred Smith of FredX, who raised his assessment of the economy and his earnings. What's going to happen here, Russ?
Yeah, I think the short-term stocks are probably going nowhere. I think we're looking at a volatile summer. The market is still digesting the fact that growth is going to be a lot slower than expectations, at least where they were a few months ago. The good news is longer term, I think stocks can move higher. Yes, there are a lot of headwinds. The economy is anemic. You've got sovereign debt issues in the U.S. and Europe, but a lot of this is already reflected in price. Broadly, global equities are trading at a significant discount. In a low inflation environment, they actually look pretty reasonable right now.
Lee Munson, do stocks look reasonable?
No, I think we have 6 weeks of market malaise, and in the next couple weeks we're going to see when earnings come out if this malaise turns into market malaria. And malaria is hard to treat and is going to end with Ben Bernanke doing some type of form of QE3 shenanigans. I'm very concerned about the long-term output, and the whole idea that we're going to, long-term, we're discounting and the stocks are going to be okay, I completely disagree with, unless we see in a couple weeks earnings come out that absolutely surprises to the upside and suggests that we can grow this economy. Because employment, it doesn't matter if you cut spending like they're talking about before or keep it. Employment's not going to happen. I really take exception to that. I think that we're in for a long, tough year.
Russ, what's your reaction to market malaise turning into market malaria? And I want to get a fix on this. Sure. Fred Smith of FedEx, is one of my absolute favorite CEOs in the country. He was a bull. Mr. Bernanke was not. Let's face it, that's why stocks seem to fall today. Stagflation, and it's all going to end happily ever after, but nobody really believed it. Who's right and who's wrong? Fred Smith versus Ben Bernanke, in your judgment, Russ?
I think you can reconcile the two. Look, this is a slow, anemic economy. Everyone knows that. We knew it was going to be a slow economy. This is what happens after credit bubble bursts. But there are silver linings to slow growth, and this is what I think we're missing here. First of all, in a low inflation environment, multiples tend to be higher. Right now, stocks have some room for multiple expansion. Second of all, a lot of people have been bearish on margins. Margins are levitating higher for two reasons. One, the cost of capital is down, that's likely to stay there, and the cost of labor is low. With hourly wages less than 2%, this allows companies to keep margins high, and even in a slow growth environment, you can generate some decent earnings growth.
Lee,
no, go ahead.
Go ahead.
Sorry.
Go ahead, Lee.
I disagree with the idea that, just because we have great margins in the S&P, that's going to mean that we're going to have multiple expansion. We've heard this all before.
I say multiple expansion because of low inflation.
Because we have expansion. Yeah, but low inflation, why do we have low inflation? First of all, we don't have lower inflation. We have food and fuel costs going higher. And as the guests before were saying,
which is already coming back.
Great consumer sentiment.
We don't have great consumer sentiment. There's a difference. I don't disagree with a lot of what you're saying, but there's a difference between the real economy and the stock market. Again, no one's debating the state of the economy. We both see an anemic, slow recovery. Corporate America is looking better. You've got great cash balances. You've got reasonable valuations. A lot of this bad news is already reflected in the prices.
Lee Munson, where's the dollar
balances
going?
Because they can't reinvest the money.
Lee, where's the dollar going?
Where's the dollar going?
Where's gold going? Where's oil going? Post Bernanke, what's your take on this?
A month ago I said that the dollar bounce was over. Unfortunately, that turned out to be the case. I think the dollar continues on its decline. I think it's in a downtrend. I think any bounce into the dollar, if you trade currency, I think you should sell it. And I think that if we get some type of relief rally, because people think that there'll be a better tomorrow this year, I think you should sell into it. I think now is the time that you should be cautious of any type of dollar rally, and I wouldn't think that it's going to persist.
Russ, give you the last word. Where's oil going and where's gold going?
Oil is probably about the right place if we don't get any more geopolitical contagion. The risk is if you get an event in Nigeria, Iraq, Iran, any of the large oil-producing countries, you do have the risk of a significant spike. In terms of gold is probably flat for the time being unless you get a geopolitical event. Longer term, I agree, the dollar goes down, gold goes higher.
All right, gentlemen, thank you very much. Russ Koesterich and Lee Munson, I appreciate it.